Hello, everyone. I'm very happy to have with me today Matty Tokenomics. I've been following Matty's work on Twitter and enjoying seeing the resources that you're sharing to help people learn about this field. To get started, would you tell us a little bit about yourself, how you got into the work you're doing, and what your background is?
Thanks, Andrew. Happy to be chatting with you again. I started my career a number of years ago in traditional finance, worked for a number of years in the hedge fund world on the trading side of things. As you can imagine, became very familiar. Some of the foundational concepts around not only economics, but also finance, right? Markets, bid asks, market caps, things that on crypto or tokens are just relevant. What interested me the most there about algorithmic trading was the decision-making logic and parameters and literally algorithms, right? Processing, making that more intelligent was very interesting to me. Machine learning, AI wasn't really a buzzword as it is now, but machine learning was getting big. I left explicitly get more into the tech side of things. Also worked for a number of years in technology, started some companies, raised some VC money, ran a machine learning Web 2 company. And during that time, also just as a hobby, speaking with protocols that had their own tokens, been acquiring Bitcoin and interested in crypto since 15, and was already working with a few informally as a member of the community, helping protocols do things like modeling and thinking through some of the implications of their decisions, not strictly token related always, but also just as someone who raised money and invested in that space. I've been doing that in the Stacks Foundation. Stacks is a layer built on top of Bitcoin, aiming to be a layer 2 for Bitcoin transactions in a similar way that Polygon or others are layer 2s for Ethereum. Anyway, the Stacks Foundation reached out and said, hey, you're already working with some of our teams informally. Would you like to do that more formally, essentially? Came into the Stacks Foundation focusing on helping teams in their ecosystem think through tokenomics, think through strategy, and also creating evergreen resources for teams. And more recently, moved over to Status, one of the earliest ICO projects in the Ethereum ecosystem, focused on a number of different things there. I lead the token economics team. We can certainly get into all of what that entails, but on a daily basis, working with projects, thinking through token related elements, but I think a lot of elements that perhaps people wouldn't immediately think of when they think of tokens, just, how do the monetization, the economics of the product itself work? Because all these and governance as well feed into it. That's what I focus on as a day-to-day role. And I also enjoy doing some mentoring of teams that are building, giving back to the community, doing some angel investing. I think it's a fascinating space. And the infrastructure projects that are coming down the pipeline in terms of zero knowledge proofs and things like this are really fascinating. I don't think most people have caught on yet, but I think we're going to see another inflection point soon in just adoption and use cases as multi-party computation, MPC and zero knowledge proofs and these sorts of things start to catch on more.
Your day-to-day work, you do some modeling and consulting related to economics of token systems or token. Could you tell us about your perspective on those things and what those words mean to you?
I think tokenomics is a term that is, you can ask 100 people and get 100 different answers, not super well defined. The way I've seen most people in the industry itself think about it is the set of monetary and non-monetary rules that a protocol employs to incentivize, their users to coordinate towards a specific goal. Those are monetary rules like governance, and you're coordinating users to achieve a specific goal. For an example, Uniswap, the product is better liquidity because traders who use the product get less slippage. The Uni token is a way to incentivize people to provide more, thus reducing slippage costs, thus attracting more traders, thus in turn attracting more liquidity providers to earn fees. This value creation and positive feedback loops are all possible when you align incentives correctly. And that comes back to the economics, similar to mechanism design, although there's other elements, but it's all of that general monetary and non-monetary rules that are employed.
It's clear that you had a strong background in finance and in tech before coming to crypto. I'm wondering what percentage of what you use did you learn through a formal education? What percentage of what you use is just through experience, sort of osmosis of being in the space?
That's a good question. I personally find that I've always learned easier, like on the job, trying something, getting my hands dirty. If I'm trying to learn like a programming language, I'm the type of learner, it's more useful for me to build a certain app or build a model to predict, match scores for a certain sport, and then go and try and do that. And when I run into a hurdle, Google or nowadays ask ChatGPT, how do I fix this problem? I personally learn that way more than in a purely academic setting. For me, I think it's very helpful that I was exposed to these concepts of like discounted cash flows and supply demand curves and these type of concepts in school. But practically speaking, how did trading and bid offers and spreads and volatility and risk management, that was more just trading on my own, traded stocks in my own like E-Trade account, right? And also just learning on the job. If you're an academic learner, I would still phrase the question that you're asking me. I think people vastly underestimate the relevance of learning about economics and finance and modeling, mechanism design and simulation, completely irrelevant to the field of crypto, right? Because those are the conceptual building blocks that crypto is a different pattern or a different implementation or a different flavor of those concepts. There simply isn't as much academic resource out there to learn about those concepts in the context of crypto. I think what's probably most useful is to learn those basic concepts in their traditional setting and then marry that with knowledge that you gain from studying and also just being a user of crypto itself. That would be probably what would be most beneficial for most people.
You recently posted on Twitter a really great thread with lots of resources for learning about this field. I wanted to ask for a complete beginner, is there any advice you would give? And what do you think was most relevant about the resources that you chose for the beginner level in that collection?
For an absolute beginner, focusing on the very basics of economics, right? Supply demand curves, price elasticity, inflation, monetary policy, all these sorts of things that you might have heard the terminology, but you don't necessarily have the right frameworks or mindset to think about the implications. A lot of people would say, well, it's obvious that if there's, high inflation, supply is going up, that means price is going to go down. And a lot of people, that's not obvious. You saw a lot of people, for example, in this DeFi summer, buying into protocols that offered like a 20,000 APY without thinking through the implication, right? 20,000 APY, all else equal, means that there's 20,000% inflation rate, right? You have these concepts that academically in isolation might seem obvious, but when you get out into the real world, especially when your own money's on the line and you're thinking, ooh, I could make this high return, suddenly it becomes a bit more complex. Really getting strong with the fundamentals is a good place to start, whether you're motivated in learning about crypto, working in crypto, investing in crypto, just learning more academically about crypto or tokens, because you need to think through the implications in the whole system, not in just an isolated case. Even the people who would say that, oh yeah, it's obvious, a lot of those people probably aren't even familiar with the concept or term of real interest rates versus nominal interest rates. That is incredibly relevant for DeFi, for inflation, token supply and yield and these sorts of things. I think people are discounting the importance of getting strong basis with economics. Some of those resources shared in that exact thread are easy to read and non-textbook ways to learn these concepts, example-based ways to learn them. Because again, at least me personally, I find myself learning much better through real-world application rather than just sitting there and reading some dry, microeconomics textbook, which is probably not most people's definition of a good time.
There's a second level of someone who might be classed as a beginner, someone who has experience or knowledge about things like economics, maybe some experience with trading cryptocurrency or reading about protocol design. But now they're actually tasked with helping a potential business implement a protocol. I'm wondering, for that, making that leap from, okay, I knew what I was doing in theory, but now I'm actually in charge at some level. Do you have any best practices or finer points for that type of person?
Certainly, this is where it becomes more important now that we're in the context of, a crypto project, to start to combine or start to build on the basic economics concepts, which are totally independent of crypto, understand at a fundamental level how, primitive or core concepts of blockchain work. How does a ledger work? How does versus how are blocks produced in a longest chain consensus model like proof of work? How are blocks produced in biggest weight a consensus model? How are blocks produced in a proof of stake like Ethereum's new consensus model? These core concepts really help to understand some of the unique aspects of the concepts within the industry or within the realm of blockchain. Then I think it also helps to marry it with some knowledge of like digital economies or digital economics, because there are some aspects in which core concepts from basic economics mostly still apply, but there's some special cases or tweaks, right? Digital economies, a lot of like even just Web 2 gaming, like EVE Online, for example, right? They have a whole economy in that game. For those not familiar, it's basically an MMO, right? A massive multiplayer online game like World of Warcraft, but in space, if that helps people understand. There's people who are harvesting, resources, minerals from asteroids and then selling them at market, and people buying them produce, more goods and weapons and fighting. And there's just a massive economy within the game. The game developers still have to do things like balancing supply and demand, looking at where there's potentially imbalances in this that would cause, one asset to spiral out of control, which would have knock-on effects and making these things more cheap. Now, all of a sudden, the whole gameplay is imbalanced and no one's having fun anymore. It's a fascinating world, digital economies. Getting in there, understanding because in real life, in real or classical economics, right, you can't just say the central bank isn't like, okay, we're going to have 1 million barrels of oil tomorrow, right? But in a digital economy, the game developer can do whatever they want, right? They could mint 1 billion, 1 trillion, whatever they want barrels of oil. Balancing you have control of with the things you don't have control of, digital scarcity, all these concepts. That is, let's not forget, that was what the brilliance of Bitcoin was in the first place, right? Was that you have this fundamental problem of, in a digital setting, I can just copy your information, right? Digital scarcity is very difficult, or was very difficult, because if you have something, there's nothing to prevent me just right-clicking save and copying it. But now that you have this chain that protects a history of transactions and accounting, you basically have digital scarcity, provable ownership. A lot of these concepts are interrelated with blockchain once you start getting into the digital aspect of it. And really the next step, I think, to learn about, to get a practical hold on some of these matters.
I want to ask your perspective about something else. I came into this space as a mathematician with experience in both modeling and simulation and formal proofs. As some of the major events in cryptocurrency happened, I was trying to come up with quantitative models for things like, say, the UST Luna collapse. I would talk to people such as yourself, and they would say, this is obvious that this was going to happen. You don't need any equations. You can just see that the structure is wrong. My question is, in terms of modeling and gaining insight, what is the relationship and the value between the quantitative models that make actual numerical predictions, the qualitative models that might just give you the system or might work on a more intuitive or less numerical level?
I think that's a great question. The first thing I want to touch on is, you said the models, the quantitative models that make predictions. I think even this is slightly a misnomer. In headlines, we hear so much about algorithms making predictions of predicting, who's going to win this match, predicting if this stock price will go up or down. Really, modeling is about risk and scenario analysis rather than predicting strictly what's going to happen, right? Even the best algorithms in the world are not predicting, okay, this is 100% going to happen, that this team is going to win or this stock price is going to go up. What they're really doing is doing risk analysis, saying what is the set of possible outcomes and what is the expected relative probability of each of those outcomes occurring. If the team is, 70% likely to win by 2 runs and 30% likely to win by 1, right? You get this spectrum of result that then you can roll up into an expected value and do some simulations of risk analysis. This gets into Monte Carlo simulations and value at risk, which is a concept from finance, TradFi, that is also very, very relevant to DeFi protocols. The leading DeFi protocols also make use of it. But I think that's slightly a misnomer, that you're predicting something when really what you're doing with modeling is risk analysis. From that lens, when you look at something like Luna, or UST, there were many people who were publicly calling it out months, if not years ahead of time, saying this is inevitable that this will collapse. I was not one of them, to be clear. There's a couple that I follow that were brilliant at doing that ahead of time. I think in that case, it's just someone with our frame of reference. We've seen it enough, right? We've worked in TradFi. We've seen enough of these things where it's not like we're doing any magic. We're just intuitively using our experience and what we know to say, look, you have increasing liabilities with flat or not increasing as quickly assets. Like, this is by definition not sustainable. When it will collapse, no one knows for sure, but will it collapse at some point? Yes. The modeling feeds into that by doing risk analysis and seeing, like, when is it possible? When is it likely that it will break? Will it break, right? Almost everything, including Bitcoin itself, including the most secure blockchain on earth, breaks under certain circumstances, right? For Bitcoin, that's a percent attack, right? Or technically greater than 50% attack, but people simplify it, right? It's a 51% attack. For Ethereum, right? There's also assumptions that it makes about the validators. If a certain number of validators are malicious or Byzantine, then it breaks. No system, whether it's natural or human-made, works in every set of situations. And that's exactly why modeling is useful. It helps you understand, given what I'm designing for, and given my risk tolerance, and given the assumptions I'm making, when does this break? Is that rare enough and not expected to occur so often enough that that's acceptable? There's always going to be some risk that you have to accept. It's about minimizing it and knowing exactly what that risk is. For people who saw Luna coming, you could just see that this is a risk that exists in almost every situation where the amount of grows so much that the market cap of UST exceeds the market cap of Luna, because now you've got a stable coin that is theoretically backed by something that isn't even worth as much as it is, right? It's as if you were backing one DAI with 0.7 USDC, for example, and saying, oh, don't worry, it's backed by USDC, right? It just didn't make any sense. I don't think it took anyone to be super, like rocket science to know that. I think it just took experience and coming from a field where you've seen this before to see that would be inevitably play out. But certainly modeling it out would be a way to also do that and get that intuition quicker.
I'm reminded of the quote by Hamming: the purpose of is not numbers, but insight.
Yeah.
Sometimes the insight comes through numbers, but however the insight comes, it's valuable.
Absolutely. I definitely agree with that. Yeah. Whether it's qualitative intuition, which, can be dangerous, obviously. You always want to back up your qualitative intuition with some quantitative analysis, but I think they go hand in hand, and people should not forget that what matters at the end of the day is the key takeaway, not the exercise itself.
I wanted to ask about the future of what you see in tokenomics specifically and in the cryptocurrency world more generally. What are some things you're excited about as potential developments in the next few years?
Yeah, I think on the tokenomics side of things, I'm excited to see there's a number of tools that already work with some of the top, biggest protocols like Curve and Compound that are basically doing this tools that let them do some of this modeling and scenario analysis much more easily. Designed for crypto use cases, obviously borrowing quite a lot of techniques, approaches, concepts from traditional finance, from traditional economics, but helping them do things like what I just described, like value at risk, right? Analysis, right? If your protocol uses collateral, right? Like analyzing what's the likelihood that there is an event where the protocol becomes under collateralized, as has happened with MakerDAO, for example, in the past, right? The more Maker tokens to re-collateralize DAI when it was under collateralized. Those are really cool developments. I think the same way you see now smart contract audits being the norm and expected, it's a must-have to be taken seriously as a protocol. I think you'll also start to see like economic audits or like design audits done by some of these platforms that help people do that. One simple example is Machinations. I know a lot of your audience that is already interested in token engineering probably knows of it, but it's a great drag and drop tool for building simulations that's also used in game design, Web 2 or Web 3 game design. They already have an additional service you can buy to basically get their experts to audit of your design, right? So it's not saying, yep, your code is written well, yep, your smart contracts are not exploitable. It's saying the economics of the system are well balanced and sustainable. I think that is a trend that you'll see much more of. In general, in the crypto side of things, the trend I'm seeing that I'm most excited about is and zero knowledge proof stuff that I was mentioning earlier, just unlocking a lot more use cases, unlocking a lot more privacy, unlocking a lot more automation. Again, not just purely in a crypto world, but also in traditional banking and other use cases that will be enabled because of the tech that's being built in crypto and cutting edge encryption advancements. I'm talking with a number of chains that are working on really, really cool solutions that will unlock more use cases for treasury management and things like that, where it will be much more relatively decentralized, relatively more trustless, moving away from this, trusting custodial entities because it just happens to be simpler, because unfortunately that also, predictably didn't go great with FTX and Celsius, et cetera. I think unlocking, being able to do more complex use cases while still retaining the trustlessness of decentralized protocols is the directionally how I see advancements heading, and that's cool.
I really appreciate your time and all the knowledge that you've shared. Is there anything you think it's important to say that didn't come up in our conversation or I didn't ask about?
That's a good question. I think something important to keep in mind for everyone is to be intentional about what it is that interests you in crypto. This can change over time. You should be intentional about it at any given moment, right? If you're changing from it interests me to be a short-term day trader to it interests me to learn about the technology, just make sure that you're intentional about that. Where I see people get in trouble is when they think that they are learning about the technology, but really what they're doing unintentionally is short-term day trading, just trying to get rich all in one trade. Or when they're trying to be a long-term trader, but short-term trading, or when they're trying to short-term trade, but not doing that. I think you need to be intentional about what is your goal, what is your objective, and what are the risks you're willing to take. In a similar mindset to modeling. If you're trying to learn about these concepts, be mindful that sometimes the best way to learning, again, at least for me, is to deposit a certain amount of money that I'm basically writing off as a learning expense. It's my tuition, and going and using these new protocols that are out there, right? Using them. Sometimes you can use the test net, which is free, but sometimes all of the features or the most meaningful features are only, just depositing what you can and actually experimenting and using some of these cutting edge protocols. And that can be a great way to learn painful lessons without actually risking or losing a lot of money, making sure that tuition cost stays under control. I think that is probably the one thing I see that they should know ahead of time, because it's easy to start doing that and suddenly you're day trading and you didn't really intend to start doing that. Your whole purpose, intention was to keep learning. Just make sure that you're intentional about what you're doing in a given time. What's your objective? What's your risks you're willing to take? And crypto is still the wild, wild west, right? There's still a lot of not even protocols that are trying to scam people, but that are just poorly designed or that, don't even know if they'll work. Yeah, it's an interesting place to be, to learn about encryption, to learn about new economic models, to learn about new business models, to make sure that you know what you're trying to do and that the risks you're taking are acceptable in the same way that you would if you were designing a protocol. That would be my advice.
That's awesome. Well, thank you so much for agreeing to talk to me. Your experience and insight are extremely valuable. I just want to say again how much I appreciate that you've been willing to share your time and knowledge, both with me and with whoever watches this. Thank you again.
Yeah, appreciate it, Andrew. I love what you're doing, and thanks for helping to spread this knowledge.